Hey everyone, this is Mithun, and this will be a presentation on application of automata theory in financial markets. Cellular automata, abbreviated CA, is a deterministic finite state machine concept invented by the British mathematician John Horton Conway in 1970. Cellular automata are discrete, abstract computational systems that are proven very useful as general models of complexity representations of nonlinear dynamics. They can be used directly to create visual or acoustic multimedia content and possibly make parallel computers. However, much of its potential remains unexplored as of now, including modeling financial markets. This includes trading stocks, currency, and other financial instruments. We choose financial aspect to explore because financial market is a perfect example of unpredictability. Even if you spend hours looking at statistics and base a game plan entirely on it, the way financial market moves can never be perfectly mapped out. Even though we have made impressive progress in machine learning and AI, even they fail here because they only work where the past, present, and future remain consistent. In a few words, you can say that financial market is a chaos. It all depends on how well a particular stock does at a particular time frame. Even if this fluctuates constantly, cellular automata help bring sense to this chaos by giving deeper insights on the patterns and forces that drive financial markets. It can give us simulations that can help us study different aspects of financial market without it being based on existing data to free it from the constraints of past and its unpredictability. Capital market theory makes reference to multiple forms of analysis that aim to predict the value of securities and the flow of supply and demand in the market. Some basic concepts of the capital market theory are the efficient markets hypothesis, referred to as the EMH, and the random walk of yield rate. These concepts will be explained in the upcoming slides. The efficient markets hypothesis was developed by Eugene Fama in 1963. The efficient market hypothesis states that the price of a stock fully reflects all the publicly available information and only new information move the value of a stock. For example, let us say you are just going about your business and you get a call from your friend informing you that a company named XYZ is going to be bought out by another company ABC. Naturally, the value of its stock might decrease. Now, you might want to sell the stocks as soon as possible, but when you check the market price of the stock, its value would have already been reduced by a lot. This is what the efficient market hypothesis means. The current price of the stock is the fair price of fair price of the stock, taking into consideration all the factors like the PE rating, etc. This hypothesis implies that the investors always lose in the long run, and no investor can make consistent gains over the market. This also implies that there is no role for both technical and fundamental analysis in trading. Technical analysis is using the past price of the stock to determine its future prices, and fundamental analysis is collecting different information about the stock, like its PE ratio and also other many other factors, to predict how the price would be in the future. Although it's a very popular idea, it is believed that it is not fully accurate, since various real life examples say otherwise. The yield rate is annual rate profit that an investor makes on his investments. The random walk theory states that it is not possible to forecast in which direction the price of investments will go. It is said that stocks follow a random walk. For example, let us say that we are an investor and this is a stock market. So let's say the price of stock is at this place right now, and it can either go up or it can go either go down. So let's say if it's going up like this and it will go down like this. These are not drawn for scale, so just assume it's like equal. So let's say the probability of it going up is 1 by 2, and the probability of it going down is also 1 by 2. And when it's going up, it reaches this point, and when it goes down, it reaches this point. So in a future where the price went up, which is this one, it might either go up again, any magnitude, it doesn't matter, or it might go down again. Same here. In this future where the price went down, it might either go up or it might either go down. In this also has 1 by 2 and 1 by 2. This also has 1 by 2. I mean, in that future it has 1 by 2. So I think you can see from here how predicting the price of stock and at any particular point of time in the future is going to be incredibly difficult, and that's why it is often looked at as gambling, which is the stock market. A random walk is a mathematical process. It describes a path consisting of a succession of random steps, like I just showed in this example. This theory also says that technical and fundamental analysis is useless since it is impossible to predict something that is entirely random. Although it is believed to be almost accurate, there is debate on its credibility. For example, no investor is able to consistently make alpha gains. If an investor makes an alpha gain 1 year, it may be due to sheer luck. The Santa Fe artificial stock market is the first artificial stock market made. It was developed in the 1970s. It uses an agent based financial marketing technique. Financial markets are complex. There is bias in the amount and type of information that is available to each individual trader. Although public information is available to anyone and everyone, insider information reach different people at different times. This means that financial markets are highly unpredictable. Traditionally, investors use technical and or fundamental analysis to predict the price movements, mostly through the use of computer programs. But this would limit them to the amount of information that they would be willing to spend money on. Also, the analysis might prove to be inaccurate. SFMASMs are rudimentary artificial markets that make use of CAs where the neighborhood is fixed. So, more advanced artificial market called the cellular automata financial market is used. The Santa Fe artificial stock market is a discrete time model that provides a basis for the rational expectations hypothesis, which says that individuals base their decisions on three primary factors: their human rationality, the information available to them, and their past experiences. It is an earlier model and it's not used anymore, but it is still beneficial to look at how it is functioned. It has N traders on the stock market. Initially, each trader is identical in nature, but they would change over time and they have same initial wealth. A time period will start from T and last till T plus 1. Financial assets are available for purchase at the beginning of each period. There are risk-free assets F in infinite supply, where traders pay a constant amount and get a return rate R for each period. There are also shares of risky stock A, where traders pay an uncertain amount dt plus 1 at the end of each period and receive an uncertain return rate RT for each period. To calculate RT, PT is taken, which is the price of A at time T. The formula for the model is shown on the screen, where this is the formula where PT is the return rate at time T and PT is the price at time T. Sorry, RT is the return rate at time T. It's shown wrongly in the slide. I'm sorry. PT plus 1 is the price at time T plus 1 and DT plus 1 is the uncertain amount at the end of each period. And E is a Euler's constant, which is 2.718. Traders use this set of rules to predict the future price and then make investments based on that. After the auctioneer receives the investments made by traders, he decides the price for the next period. Oversupply indicates price drop, and short supply indicates price high. Although the SFASM is a great model, it was still rudimentary, as in it had a variety of shortcomings. The major shortcoming with this model is its portrayal of information flow. Since this model is correlated to efficient market hypothesis, it portrays information like EMH does, as basic of price of stocks. But in real markets, information is highly complex. Apart from price of stocks, there are other public information and insider information. Even the psychology of traders comes into play, as their emotions can make them more inclined towards one stock. Since real markets are also time complex, the reaction time of different investors also add to the complexity. So, straightforward model with no delay is not highly accurate, and that is how SFAMS or SFASM was modeled. Sorry for that. Mm. Excuse me. The cellular automaton model of investment behavior in the stock market was developed in 2003 and is a typical cellular automata based artificial market. The neighborhood in this model follow Moore's definition. This model went in a completely different direction than SFASM by only taking into consideration the local interactions and disregarded the public information. It gave a new insight to AFM, but by ignoring all the other factors of stock market, it proved to be less insightful than SFASM. It can also be observed that multi-agent and cellular automata are equally suitable for modeling this extensive market. On extending the essence of classic cellular automata, it can be learned that it consists of a heterogeneous mixture of cells and socially related neighbors, providing a higher chance to develop artificial financial market based on cellular automata. For this, we have to extend the quadruple system of cellular automata, so six-tuple system, which is shown in the screen. Again, we are showing the screen. The formula is shown. Considering the inclusion of neighborhood transformation function in the cellular automata, it now contains a six-tuple set. In this new definition, set replaces the conventional ZD, which implies that the space occupied by this automata doesn't necessarily have to be a Euclidean space and can be a network or a graph structure instead. And hen in the above set tuple implies a graph's neighborhood definition. To add on, n doesn't have to be stable. We take patches of successful parts from other models and build around it. The main target of this model will be to fill in the missing gaps in current models, like the relationship between dynamics and the structure of a financial market, and focus on verification of different capital market theories. We keep in mind the previous works in this field and also their shortcomings while we attempt to design a new model based on cellular automata. We will design its framework using C++ language. This is because C++ allows generic programming and parallel framing. Simulation of an AFM is also evolution of the cellular automata. We can run parallel simulation as it gives higher performance but also ensures that the evolution and simulation run close to real markets. One simulation can run over many days and will stop when the user wants to or in an unlikely event of market crash. After each trading day, AFM will be closed and accounts settled, just like a real market. After simulation of a cycle is over, a report of the simulation will be generated. CAFM has tools that can analyze this report and compare it with real markets to test its accuracy. The report analysis will give insights to the simulation and even point out the things a designer may have missed. It's difficult to include all the aspects of real market in this model, but the way information is intercepted and the way it travels across a neighborhood in a CAFM is an insightful approach that can become a stepping stone for further research in this field. Cellular automata is the best tool we have right now to build an artificial market that resembles a real market. However, cellular automata alone cannot be used to accurately design an artificial market. Cellular automata can be used to simplify the flow of information, which is a complex model of its own. This goes on to say how cellular automata can be used for particular aspects of financial market, but it alone is not effective enough to create a long-lasting stable model. That was it, and thank you for giving me the opportunity. I thank you.